Hey folks, it's Kevin. In this video, we're talking about whether or not paying down an interest rate makes financial sense. A common misconception that people have is that a lender will offer you one interest rate based on where your credit score is. This is not true. In fact, a lender will offer you what's called a pricing sheet, which is a list of interest rates that you can choose from. So let's say based on where your credit score is, the lender offers you a 2.5% interest rate, and they also let you know that this is going to come at no cost to you should you elect to move forward with that specific interest rate. This is what we call the par rate, which simply means that they're not going to give you any credit towards your closing costs, and you're also not going to have to pay to get that interest rate. However, let's assume that you want help paying for your closing costs and you're willing to take on a higher monthly payment. In this example, the lender can increase that interest rate to 2.75 and give you a $5,000 lender credit that you can then use towards those closing costs. This is what we call a lender credit. And for most people who don't have cash available, it's very attractive because it allows you to finance those closing costs over a 30-year term. Then there are buyers who have more cash available and they're looking to own this home long term. So to them, it makes more sense to get the lowest interest rate possible. So they may elect to pay the lender more money than is necessary to buy down the interest rate, which is essentially the inverse of a lender credit. But does this make financial sense long term? Let's assume for this example, you're purchasing a $600,000 home and the lender is going to be offering you a 2.375% interest rate. You have $20,000 that you're willing to put into the home, but rather than putting it towards a down payment, you choose to buy down the interest rate. Now the lender can offer you a 1.75% interest rate, which would be a monthly savings of $185 or an annual savings of $2,200. So I know what you're probably thinking. Why would I invest $20,000 that I don't necessarily have to just to reduce my payment by $185 a month? Well, let's take a closer look. Remember when I said earlier that this specific buyer was looking to own that home long term? Well, in this specific scenario, that may not be the worst idea. As you can see by the figures on the screen, if you were to save $185 a month, that would mean that the break-even point would come at the 9-year mark. And all that means is that if you save $185 a month, how long would it take for you in order to recuperate the $20,000 that you invested? So now that we know that on the 9-year mark, you make back all the money that you invested to buy down that interest rate, that would mean that the remaining life of the loan, which is initially a 30-year loan with 21 years remaining, you would save $185 a month. And on an annual savings, that would come at a gross $66,000 and at a net of $46,000. And with all things being equal, considering that interest rates don't drop, making you reconsider why you paid $20,000 for a lower interest rate, nor that you intend on investing that same $20,000 into another investment vehicle that can yield a higher than 11% return, I would say that paying down that interest rate to be a long-term owner of that property does make financial sense in this specific scenario. However, these situations vary depending on your spending and investing habits, and it certainly is not a one-size-fits-all loan scenario. Please do not take this as financial advice. This video was for entertainment purposes only, and I do advise you to always reach out to a licensed loan officer in your area should you have questions regarding your interest rate or your specific home purchase scenario. With that being said, I hope that you found value in this video. Please send it to a friend or a family member who's thinking about purchasing a home. And lastly, subscribe to my channel to stay posted for any future videos. I'll see you in the next one.